Realty Income reported their earnings this week and it was a miss on the AFFO. We're going to discuss this in today's episode in detail with all of the updated figures. We're going to take a look and see what the key metrics have to say if we can look past this miss on those figures. We're also going to take a look and see how they've performed on that quarterly basis versus the same period last year, as well as looking at their full year 2023 versus 2022, whether or not we can see any progression over the last few years and quarters. We're also going to talk about a bit more detail from what we discussed in the last episode about Realty Income purchasing some additional assets over 5 countries and doing essentially a sale and leaseback with a huge European retailer, Decathlon. We're also going to talk about how strong their returns is, not just the dividend, but also their return, and looking compared to the S&P 500. And for those that are new to the issues surrounding REITs, we're going to have a very quick look at their debt levels with the increase in the interest rates and staying higher for longer, the words coming out of Jerome Powell's mouth. We're going to look and see how much of their debt is fixed and for how many years to see if there are any issues. As always, we are going to run them through the valuation model. Now we have their earnings report, the updated figures, to get to our intrinsic value, get to our acceptable buy price given our investor margin of safety, and we'll look to Wall Street to see whether or not they still see upside after this earnings report. Now we're also going to take a look at the dividend safety based off of this and the metrics given how these numbers have been updated for 2023, whether we can see some trends that are looking positive. We'll very briefly again run them through the insider buying and selling screener over the last few weeks and see whether or not there has been any movement post the earnings announcement. We'll also have a quick look at the institutions, whether they have now been buying this week after this announcement. And we'll look at the updated figures on the income statement. We'll take a look at December 2023 on the top line revenue as well as the bottom line net income. And we'll look at their balance sheet from this report to see whether or not their cash is in a strong position versus their total debt. So let's take a very quick look now, just a quick update. This is down nearly 20% over the last 12 months. But again, bear in mind this doesn't include those dividends reinvested. And if you have been investing for the last 10 years, you would be up 22%. And do bear in mind, they do pay dividends on a monthly basis. And their all-time high pre-pandemic February 2020 at just under $80. They currently trade in the mid to lower end of the 52-week range, with a yield now sitting at just under 6% and a forward P to FFO of 12.41. So let's first jump into their earnings before we take a look at any of the information that we typically do on the channel. So first we can take a look at their performance, their top line over the last few quarters and on a full year. So their total revenue, so this is the top line, 2023 for the quarter came in at just over 1 million, in fact 1.1 million for Q4 of 2023. Now comparing that to the same quarter last year, they came in at 889 million. So nice to see growth quarter on quarter from 2022 to 2023. And if we expand that to 2023 for the full year, we see that in actual fact their top line increased very strongly from 3.3 million to 4 million. So growth not only for the full year, but also quarter on quarter from the previous year, looking very healthy. Now, in terms of looking on a per share basis, unlike other companies where we look on an earnings per share, we draw your attention to the AFFO, adjusted funds from operation per share, a lot more relevant for REITs as opposed to your typical company. Quarter on quarter, well, the same quarter in 2022, they were $1 per share. 2023, we do see an increase of 101, but a relatively small one, nonetheless still looking positive. And on a full year basis, we see it go from $3.92 to $4. So not only has their top line increased quarter on quarter, year on year, but so has their AFFO, which is very, very much a positive sign for Realty Income. And when we look at the metrics, we are going to take a look in detail at the percentage growth, as that is very important. Now, on the previous episode, we did discuss about the sale and leaseback of some assets that Realty Income had purchased. Well, looking at their investor presentation that they did release just yesterday, we can see now confirmed they have purchased 82 million assets across 5 countries for 527 million. And we can see Decathlon, for those that don't know, is the world's third largest sporting retailer, which is very positive. In fact, over 15 billion in revenue across many stores, over 1,000. And we can see here Decathlon accounts for approximately 1% of their totalized annualized base rent. So very positive. This is something that is separate to their earnings report, but we thought we would draw out as we did talk about it in a little bit of detail in the previous episode. And for those that do want to see, we have a bit more information about the sale and leaseback, and essentially it is broadening Realty Income's European platform, so they are expanding not just in the US but also across Europe, which is a very positive sign for the company and more importantly for the shareholders. So one thing I just wanted to draw out, a lot of people tend to look at Realty Income, compare it to the S&P and say that the S&P has a lot more growth, even when including dividends. So what you typically get with an investment in Realty Income, 4 to 5% year-on-year dividend. Now, right now, as we mentioned at the beginning of the episode, this is touching 6%. So actually, it is a lot better than the historical average of the yield. Again, we'll look at dividend yield theory shortly to discuss. And you're also getting the AFFO per share growth of 4 to 5%. So there are lots of positives here. You're not just getting that yield increase, but also the adjusted funds per share growth. And in totality, in fact, the total operational return, 8 to 10%. But if we take into the fact the yield is now sitting at 6, you're looking at 10 to 11%. So very positive. And we can see year on year, if you wanted to look cumulatively, Realty Income would give you around 126% return over the period, whereas the S&P 500 median 129%. So not too far off each other, and do bear in mind though, Realty Income does pay dividends on an essentially monthly basis. Now, one thing they did release, as they always do, the Q4 supplemental information that I did want to draw your attention to. For those that are new to Realty Income, they do, which is typical of REITs, hold a lot of debt. But what I wanted to point out here now, their total fixed rate debt, which is essentially 21 million, so working out to be 94.3% of their total debt, is fixed. So 94% of their total debt is fixed. And from that, a lot of people do worry with the interest rate staying higher for longer, that will really hurt these REITs, who will have to essentially refinance these on different interest rates, much higher than the over 5%. Now, we can see that 86.4% of their total debt, which is fixed, is on a rate of 3.77%. So that is much lower than the rate now in the US of over 5%. And on top of that, this is being held until maturity as a weighted average of 6.7 years. So in reality, they hold 86% of their total debt under 4% interest rate for an average of 6.7 years. If you do worry about the interest rates and how it will affect these REITs, unless you're thinking that the rates won't get cut to a much lower rate over the next 6 to 7 years, then in reality there isn't too much to worry, in particular with Realty Income, as an example, given we have taken a look at their supplementary debt information. Now finally, before we look at the typical data that we do on the channel, with their AFFO, it did come in at $1.01. However, it did miss the Zacks consensus analyst estimates by 1 penny. So unfortunately, they did miss on the AFFO. However, when we do take a look at their total revenue, it did come in at 1.08 billion, in fact, for the quarter, which, as we can see on top of the AF, it was a beat versus the 1.05 billion. So a beat on the revenue. However, on the AFFO, they did miss very slightly. And one thing for those that do keep up with this, we can see that they did essentially close on that Spirit Realty merger, as we can see here. Concurrent with their fourth quarter earnings release, Realty Income closed the merger with Spirit Realty in an all-stock transaction. So as we say, it will be nice to see how that does affect Realty Income moving forwards and for their full year 2024 report. So let's take a look at the information now. What we've essentially done is we've run Realty Income through the stock screener versus essentially the buys and sells of management. We've looked at over the last month just to see anything relatively recent in terms of February 2024. And what we can see, even after the earnings report, there has been no insider buyers or insider sells. But as always, we do like just to be completely transparent on every episode to have a quick look. In terms of insiders and institutions in this aspect, 79% of ownership is held by them, and we can see whilst over the last 12 months, 5 billion versus 2 billion worth of sales, what we do know in the more recent quarter after the earnings report and over the last few weeks, Realty Income has been bought a lot more by these institutions, 1.85 billion versus 285 million. So Yes, institutions do like Realty Income a lot, but as we always say, and as we can see here, whilst they have bought more than they have sold every single quarter in 2023, always do your own due diligence and never copy what the institutions do. Also, one thing we did want to draw your attention to the industry as a whole, and when we look versus the retail REITs aspect, over the last year, we can see the industry hasn't performed that well. Yes, Realty Income is down 15%, and yes, this does include those dividends reinvested. But other than SPG, Simon Property Group, which is up 34%, the rest of these REITs, which are very comparable to Realty Income, have performed very, very poorly. Now, when we expand this to the last 5 years, we can see a very similar story. In fact, the best performing is Kimco Realty, up 40%. And whilst that isn't a bad performance necessarily over the last 5 years, we do note this aspect of the REIT industry has performed very poorly. But very important to understand, past performance is never an indicator of future performance, but always good just to take a look. As we always do, we now have the full year December 2023 report. So what we want to do very quickly is look at their top line and bottom line movement. 5 to 10% for REITs is what we typically target. Well, 1.5 billion was reported by Realty Income in 2019. Their latest report released just a few days ago, 4.1 billion. So astronomical growth, very, very strong, even better than the typical that is expected from REITs, as we can see as well on a more granular level, increases year on year. When we convert that and look at the bottom line net income, the story that we can see there, essentially very similar. Their bottom line has doubled, 437 million in 2019 to 872 million. And again, on a more granular level, a little bit of an inconsistency with a drop to 2020 and then in fact down to 2021, but it does pick up very nicely, and we can see over the longer term the bottom line has looked very well. But as we will take a look shortly, adjusted funds from operations growth is a lot better to analyze for REITs. Very quickly then, with their updated cash level, we do see it go up from 54 million in 2019 to 233 million. And when we compare that to their total debt numerically and directionally, we see it go up from 8.1 billion to 22 billion. So that is a large growth, in fact, but for REITs, again, very typical. This is expected as they do try to expand, and we'll touch upon that when we do look at some of their metrics, and notably their net debt to EBITDA. So let's take a look at their financial metrics and that dividend safety updated for 2023's results just a few days ago. Dividend safety score still sits at 80, it is still safe. Market cap 45 billion, it is a large cap company. Now, in terms of the key recessionary metrics, well, they increased the dividend during the last recession, above average growth, but also outperformed the S&P, negative 43 to the S&P's negative 55. Very typical with Realty Income. They'll increase that dividend around that 4% mark, which as always, we do advocate 4% increase, whether that's your other income producing assets, your dividends or your salary, just to keep up in line with inflation. A lower than inflationary increase over the last 5 years, but over the last 20 years, 5% looking very nice, coupled with that nice starting yield. They are also a dividend aristocrat. They have increased those dividends for 25 years or more, and also paid a dividend for 54 years without a reduction. So in terms now, when we take a look at dividend yield theory, for those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average, 5.86 versus 4.43. So we have our first sign of undervaluation, although do bear in mind we're not looking at any of these models in isolation, and we'll conclude towards the end. Forward P to AFFO, well, 12.5 versus 17.8, so we have another sign of undervaluation. And we do note it is even lower than the real estate sector P to AFFO. Now, typically on the channel, we do focus on the free cash flow payout. However, for REITs, a lot more volatile. So we stick to the adjusted FFO payout. Below 90% is our blanket rule for REITs in general. What's nice to note, not only has it never been above 90%, but it has been decreasing year on year. 76% now declared in 2023. 2024 expected to go slightly lower to 73%. Adjusted funds from operation, well, we can see that consistent growth year on year. Nice to note, $4 in 2023 from their report for the full year. Expected to go up very strongly in 2024, and that does seem to be the case with help of that merger from Spirit Realty. So in terms of the adjusted funds from operation per share growth, nice to see that even though it is very inconsistent, the figures are still very strong. And whilst we note a 2% increase in 2023, 2024 is expected to see a nice strong 5%. Sales growth, as we mentioned, for REITs, strong, moderate growth between 5 to 10%. Very, very strong. In fact, look at the last 3 years. Absolutely very, very beautiful to see those strong double digits. 22% in 2023. 2024, I would expect at a minimum something very, very similar. So numerically, for those that want to take a look at the numbers, we can see their top line has gone from 930 million in 2014 to 4.08 billion. Shares outstanding, very typical of REITs, as we always say, although Realty Income are one of those that dilute your position at a much faster rate. It is always typical to see this dilution. The reason for this is they need to issue equity to fund property acquisitions for growth, as they do retain a little of that internally generated cash flow after paying those dividends. Talking of shares outstanding and share buybacks, we have done in our latest free weekly newsly article talking about companies that have done a lot of share buybacks, which is what we love to see as investors. If you want to grab a copy completely free, all you need to do is click on that pinned comment. We also have many other articles that you have full access to by clicking on that link. So let's now jump into the other metric, the ROIC, return on invested capital. Now, this is one of my 7 golden dividend metrics. One of those free weekly newsletter articles is about the other 6 as well, if you want to take a look. 3 to 5% for REITs is what I want to see. It gives me faith management are able to effectively allocate their capital. And what we can see here is, over the last 2 years, it's been at the bottom end 3%. Not the greatest, not the worst, but something just to keep an eye on moving forwards. Operating margin looking very healthy in the mid-40s consistently, 42% in 2023. Finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. What we're looking for here, this essentially shows us 2 things. 1, the balance sheet strength. Secondly, the dividend safety. So this is a number of years it would take the company to pay off all of their debt net of cash on hand. 2023's number is now in at 5.88. Now, what we want to see is below 5.5, but the positive to take from here is 2024, they're expecting to drill this down all the way to 4.67, which is very positive to note. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And typically on the channel, we do run through every single one of these models. And for today's episode, we can jump straight into the first relevant model, as Graham's isn't applicable for REITs. So the multiples valuation model, companies in a similar sector and size which have been updated for their earnings release. We get the P to FFO multiple, the average, and we have their own P to FFO to get an intrinsic value here of $65 with our first sign of undervaluation, although bear in mind we're not looking at any of these models in isolation. We then have the dividend discount model. As always, their average growth is around 3 to 5%. We can see we have gone pretty low, a bit conservative at 3.25 to give us a value again of showing some severe undervaluation to Realty Income's price even after their earnings. We then have the DCF model with the free cash flow year on year. The average growth rate, again, we've gone pretty consistent as usual, a little bit more conservative as well. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here, again, undervaluation. So the intrinsic value for Realty Income in today's episode is the average of these 3 models, coming to $66. Don't forget you can click on the pinned comment below if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment. So we typically start off with a margin of safety of 10%. For new viewers, the reason for this is because it meets 3 criteria: a wide moat, strong financial metrics, good forward-looking data. If we believe that applicable for Realty Income, we get a margin of safety of 10%, a buy up to $59, and then we keep going towards the value of the current market price. 15% an acceptable buy up to $56. At 20%, pretty much bang on the current trading price. So we see right now a margin of safety of 20% for Realty Income based on our estimates and judgments. In terms of Wall Street, their forecast is $63 over the next 12 months post the earnings release. They still see strong upside of 19%. They do believe Realty Income is a strong buy now. But as always, I'm interested to hear your thoughts after the earnings report. Did it give you more faith in Realty Income? Is this one maybe you're still adding or you're waiting for it to drop further? In my opinion, I have always said in these episodes that $52 is when I will start to add more to this position. It is one I already do hold. And over the last few weeks, when it has been straddling around that $52, I have added more shares to the portfolio and will continue to add if it does go below 50 into the 40s. As always, let me know your thoughts. Smash that like button if you've enjoyed today's episode. Hit that subscribe and bell button if you want to be continually notified of these videos as they drop. And as always, have a great day. See you on the next episode and take care for now.